The stock of Tata Motors tends to rise from the ashes every time it's written off. When the economic crisis of 2009 made it a penny stock, few thought the stock would recover. But the stock gained 1,780% over the next 6 years. COVID 19 led lockdown once again took the stock to its historic lows. Between April 2020 and April 2024, the automaker's market capitalization surged by a staggering 1,250%. Meanwhile, the benchmark Sensex went up 177%. It is not just the rise in stock price that investors are pleased about this time around. The company's market share also has grown from about 5% to 13.5%, with sales of nearly 40,000 vehicles a month. With a renewed product portfolio, cost optimization, better distribution network, and affordability, the automaker has once again caught the fancy of private car buyers. Most importantly, the well knit electric vehicle ecosystem of the Tata Group has stood in good stead. Tata Universe is an ecosystem that will leverage group synergies from companies such as Tata Power, Tata Chemical, Tata Autocom, Tata Consultancy Services, Tata Digital, Tata Elxsi, Tata Motors Finance, etc. So when it comes to growth and profit expectations in future, Tata Motors has a lot to lean on. The company has undoubtedly leveraged the EV ecosystem of its sister concerns to fetch steep valuations over the past few months. In addition, its EV capex outlay of 150 billion rupees over the next 7 years is also being closely watched. So, despite having its return ratios still in single digits, Tata Motors EV by EBITDA multiple has moved well beyond the long term average in recent months. At the same time, however, the stock of Maruti Suzuki has languished due to its very slow and limited foray into EVs. Maruti had always been the stronger entity when it came to the passenger cars, while Tata Motors' core domain was electric vehicles. Maruti's low cost manufacturing, coupled with a distinct advantage of product positioning in India, has helped it offer vehicles that are affordable, low on maintenance costs, and with superior fuel efficiency. The company also boasts an impeccable sales and service network, apart from its goods resale value, all of which have contributed to the car maker's success. Since 2001, Maruti's market share has hovered around 50%, barring a blip in 2012. Also, in 2023, its market share went up to 43% from 39% in 2020. Unlike Tata Motors, Maruti made a late entry into the EV race. A number of factors, including little government support, subsidies for personal EV vehicles, lack of proper infrastructure such as parking and charging spaces, amongst others, were the reasons behind the decision. The automaker instead focused on other alternative technologies such as CNG and hybrid vehicles to reduce its carbon footprint. However, Maruti is now expecting to fetch almost 20% of revenue from the EVs alone by 2031. Compared to Tata Motors, Maruti has sustained better return ratios in double digits. Moreover, EV by EBITDA multiple is currently close to 10-year average. So, what could comfortably turn the tables for Tata Motors and Maruti Suzuki in terms of valuations? Well, India has no restrictions on the import of electric vehicles from any country, including China, under a new EV policy. In March 2024, the Indian government approved the new EV policy under which import duty concessions will be given to companies setting up manufacturing units in the country with minimum investment of $500 million. The companies would set up manufacturing facilities for EV passenger cars, which will be allowed to import a limited number of cars at a lower import duty. Duty of 15% would be levied on vehicles costing $35,000 and above for 5 years. At present, cars imported as completely built units attract customs duty ranging from 70 to 100% of cost above $40,000. So, the policy does aim to attract global automakers like Tesla to India. This would ensure sufficient technology transfer and create a robust supply side ecosystem for EVs. In Feb 2024, VinFast, Vietnam's leading electric vehicle manufacturer, began construction work for the first integrated TV manufacturing facility in Tamil Nadu. However, the key concern is that the new EV policy may lead to a large scale entry of Chinese automakers like BYD in the local market. The Chinese market has robust raw material processing capabilities and a strong density of local EV manufacturers, leading to a secure supply chain and significant product rollouts. On the other hand, India is heavily reliant on foreign markets to procure raw materials of batteries, which leads to a high total cost of ownership for EVs, resulting in relatively lower adoption than the global players. Therefore, the new EV policy clearly puts out stocks of overvalued EV makers like Tata Motors at the risk of a crash. More reasonably priced and well diversified entities like Maruti, nevertheless, may remain unaffected. Also, if you compare the financials of Tata Motors versus Maruti, you will find that the latter offers far more confidence in terms of debt to equity, return ratios, and dividend. Moreover, Maruti Suzuki has embarked on a substantial capital expenditure of approximately 1.25 lakh until 2031. This investment aims to expand the product lineup from 17 to 28 models and increase the annual production capacity to 40 lakh units by 2031. However, the stocks in the EV ecosystem, which are to benefit from the localization of EV manufacturing, are set to gain the most. For instance, stocks of companies producing lithium batteries for the electric vehicles. Check out my video on the safe stocks to ride India's lithium megatrend. I have shared the link in the description below. Hope you like this video. Thanks for watching.